family. I welcome you to the Able Consult platform once again. Today we are coming to learn accounting for oil and gas. So we start with what's made up of cost in oil and gas sector. From our basic knowledge from cost accounting, we know that elements of cost is made up of material cost, labor cost, and then expenses. That's being direct expense and then indirect expense, direct labor cost and then indirect labor cost, direct material cost and then indirect labor cost. But when it comes to account oil and gas sector, the elements of cost are four, and they are acquisition cost, development cost, production cost, and then exploratory cost. So these are the elements of cost under oil and gas accounting. So first one is the acquisition cost. So acquisition cost is the cost incurred in gaining the legal rights or the licensing for extraction of the hydrocarbons. So hydrocarbons is basically the net crude oil and then the natural gas. So before the oil and gas or a company will be able to extract the oil and gas from the field, they must gain the legal right before they can do so. So the cost involved in acquiring the legal rights form part of the acquisition cost. And then the second element is exploratory cost or exploration cost. Exploratory or exploration cost is the cost incurred in preparing the site or the field, or the cost involved in developing the reserve. And the next is the development cost. Development cost. So for development cost, after they are done drilling the hole and then they have seen the reserve on the ground, these are the further costs that they incurred to develop the reserve in a commercial quantity, or when they see that the reserves is viable, it means they must invest further to enhance the operations or the activities when it comes to the drilling and then extraction of the oil and gas. And then the last one is the production cost. So production cost is the cost incurred in extracting and then lifting the oil and gas from the reserve or from the ground, and then the cost incurred in transporting and then storing the oil and gas. So these are basically the elements that made up cost in oil and gas. So we proceed with how to account for oil and gas. Since oil and gas is capital intensive industry, which means that the investors must invest a lot into the operations or activities of the organization. So the various stakeholders are those who have interest in the performance of the organization. Normally demands financial information in order to enhance their decision making and then operating activities. So it means at the end of the accounting year, the organization must prepare and then present the financial statement to the various stakeholders. And then before organization can prepare its financial statement, it needs to record the transaction which took place during the accounting year. And then when in accounting, we have a lot of principles and then concepts that guide how transactions must be recognized and are recorded in the financial statements of the organization, in the books of the organization. So when it comes to accounting for oil and gas, we use historical cost principle. That's historical cost principle. So the rationale behind the historical cost principle is the cost of the asset, or the cost for the asset, or the amount for the asset that to be recorded in the books of the organization must to be the actual cost that the organization paid for when they were acquiring the assets. So for example, in case the organization bought this marker for 20 cedis, it means that they must record the cost of the assets at the price of 20 cedis. Although there might be inflation and then deflation, which can increase the value or the price of the marker or reduce the value or the price of the marker. But because of the historical cost principle, they will still maintain the cost of the assets at the price, that's the 20 cedis. And then historical principle have two ways of recognizing or recording transactions in the books of the organization. And then these two principles are successful effort method and then full cost method. That's successful effort method. And then the second one is full cost method. So we take these two methods one by one. We will look at the differences between the two and then the similarities between the two. So we are starting with successful effort method. So for successful effort method, it means that only direct cost or cost that directly associated with the asset must be recognized or must form part of the cost of the asset. Any other indirect cost will be written up as an expense in the income statement at the end of the accounting year. And then all costs that successfully leads to discover of reserve will form part of the cost of the assets. And any other costs which are unsuccessful will be written off in the books of an account in the income statement as an expense. And then when it comes to full cost method, for full cost method, once the organization incur the cost, automatically it forms part of the cost of the assets. Whether it leads to successful discovery of reserve or not, it will still form part of the cost of the assets. So one way to differentiate between these two methods is either an expense or either a transaction will be capitalized or expense. So expense means the cost of the asset or the transaction will be written off at the end of the year against our profits. So it means that the transaction will be treated in the income statement as an expense. And then if the transaction will be capitalized, it also means that the transaction will form part of the cost of the asset. So when transaction is being capitalized, it means it will form part of the cost of the asset. And then when transaction is being written off, it means that it will be treated as an expense in the income statement and then to be written off or it will be marked against our revenue for the year. So in relation to the four elements of cost, that's our acquisition, exploratory, development cost, and then the production cost. For acquisition cost, both successful effort method and then full cost method capitalize it. So it means when it comes to acquisition cost, it forms part of the cost of the assets. And then for development cost, both two methods, both of them capitalize it as well. And then when it comes to production cost is written off against our profits. That it will be treated as an expense in the income statement at the end of the accounting under both methods. And then for exploratory cost is recognized or is capitalized under full cost method. But for successful effort method, if the exploratory cost leads to discovery of reserve, it will be capitalized as a form part of the cost of the asset. But any other unsuccessful cost will be written off as an expense in the income statement. And then another major difference between the two methods is cost center. That's cost center. So cost center simply means a location or a department in the organization that track costs and then expenses. So under successful effort method, cost center is basically the reserve or the field in which the organization is operating. So for example, in case an organization is operating in the Western region, for example, in case organization is operating in Western region, that particular expenses that relate to that particular activities will be recognized. But for full cost method, the cost center is the country. So in case a company is operating in Western region, Central region, and then Greater Accra, all the activities will be accounted at one particular cost center. So the whole country, like the activities of the organization, the entire country will recognize at one particular cost center. But for successful effort method, each field or each operations will be accounting for their cost or expenses separately from each other. So basically, that's how we'll be accounting for cost and then expenses and accounting for oil and gas using the two methods. So we will continue by seeing how we may treat certain expenses or items under the two methods. So items, and then under successful effort, and then full cost. So we take the item one by one and then see how we'll be treating them under successful effort and then the full cost method. So first one is the acquisition cost. I have already explained what acquisition cost is. So acquisition cost is form part of the cost of the asset under both methods. So it means under successful effort and then full cost, we capitalize them. Okay. And then the next is D&D cost. So D&D means geological and then geophysical cost. D&D cost. So for D&D cost, under successful effort method, it will be written off, that it will be treated as an expense, and under full cost method, it will be capitalized as the form part of the cost of the assets. And then the next is exploratory dry hole. So dry hole in oil and gas means that the operation was unsuccessful. After drilling the hole, they were not able to discover any oil reserve in that particular hole. So under successful effort, dry hole simply means that the activity was unsuccessful. So it will be written off as an expense under successful effort method, and then under full cost method, it will be capitalized. The next is exploratory work that's successful. Once it is successful, it means that it will form part of the cost of the asset and a successful effort, and then under full cost method, it will form part of the cost of the asset. So under both methods, we capitalize them. The next is development of dry hole. So for development cost, once it is development cost and the both successful effort and then full cost method, we recognize it as part of the cost of the asset. So it means it will be capitalized under two methods. The next is development was successful. So this one, to development were successful, it is also capitalized under the two methods. And then production cost. So for production cost, it is written off as an expense under the both method. And then last one is amortization, depletion, and then depreciation. So DD&A means depreciation, depletion, and then amortization. So this is similar like what we know under our normal accounting. For depreciation, that's the reduction in the value of assets. Amortization, that's the reduction in the value of intangible assets. So for them, in our normal accounting, we treat them as an expense in the profit and loss account. So same situation applies in the accounting for oil and gas too. So for depreciation and amortization, it will be written off as an expense in the income statement at the end of the accounting year. So under both methods, it will be expense or recognized as expense. In conclusion, all items that will be treated as an expense or that will be expense will be treated or will be recorded in the income statement. That's the profit and loss account. And then all items that have been capitalized will be treated when preparing statements of financial position or balance sheet statement. So note, under full cost method, only transactions that will be written off or that will be recognized as an expense is the production cost and then DD&A, that's the depreciation, depletion, and then amortization. The remaining transactions will be capitalized or form part of the cost of the asset. And then under successful effort method, D&D cost, exploratory dry holes, and then DD&A, that's the depreciation, depletion, and amortization will be written off as an expense, and then the production cost as well. So we will end today's sessions here. In our next session, we will continue We will continue by solving a practical question. After that, we continue with accounting for overlift and then underlift. See you in our next session.